Welcome back. Let's start by understanding how you can keep track of a simple business. Let's say you have $10,000 in savings and you want to start a manufacturing business. In order to set up a unit, you need to buy a place. Let's say you get a place for $3,000. Let's write this down in order to keep track of money. So you write down land/building, $3,000. Let's say you also buy machinery worth $3,000. Apart from this, you need money for raw material, employee expenses, and other miscellaneous expenses like electricity bill, office supplies, etc. To meet these expenses, you keep $4,000 in cash with yourself. By writing this all on one side, you know how you have allocated your money. In order to keep track of the original money you started with, you create another column and write down this amount of $10,000 on the right side here. In accounting, the term owner's equity is used to denote this sum. This table here can help us keep track of our investment, and this table is actually a simplified balance sheet. By looking at this, anyone can say that $3,000 was invested in buildings, another $3,000 went into machinery, and the rest of the money is held in cash. All these items on the left side of the table are known as assets in accounting. Since the money for all this came from the business owner, he owns all the assets of this company, and this ownership is denoted on the right side of the table as owner's equity of $10,000. By comparing the sum totals on the left side and the right side, we can be sure that we have accounted for every penny of owner's money. This was an example of a simple balance sheet. In the next video, let's complicate this a little.